I'd like to shift gears now and kind of drop into some passion points for you and some really deep domain knowledge that you have and tap into that. And so the first one is inflection points.
Mm-hmm.
You've written about this again. I'll put a link in the show notes, but let's take listeners through the basics here. What is an inflection point? And I think you've spelled out some of the key examples. So maybe you could just provide some of them too.
Yeah, absolutely. It was one that kind of came to me from experience noticing these things. So it wasn't, it was only later, looking up the word inflection point, I think that's probably the way that it fits what I've observed. So it's essentially a point in the company's life where the fundamentals of the business are going to be radically different to the past. And I say fundamentals is a really important point. It's not technical analysis or anything else. But I think those points, anytime that I'm investing actively, I'm trying to find mispricings in the market, which means someone else has done something wrong or misunderstood something. And that could be emotional, it could be they have bad process, could be they're not able to analyze this thing. And I think these points where the future is going to be very different give us that opportunity, because you can't just look at the past financials and say, extrapolate forward, because there's a big step up. So it could be a lot of different things. I mentioned in that article the example of a corporate turnaround. Obviously someone had written about it at uni and whatever else. So that's kind of my first foray into this, is coming from a value investor background. So instead of, most value investors see a company that's kind of in trouble and see that they think it's undervalued and buy. And I think for me, there's a better opportunity to wait until the company's actually started turning. So a lot of people say this is a turnaround, in 6 months it's going to be great. And I like to just look for opportunities to see evidence of that happening. It comes back to forecasting. Forecasting is very good, and I think you should try to do it, but it's even better if you can just observe the world as it currently is, rather than trying to predict how it's going to be. So trying to find ways to observe that a change has already happened, so it's tipped past that inflection point, that point where the future is very different to the recent past, and then that can be a great time to invest. And it still comes back, you have to do evaluation, but it tends to be an opportunity. It's like a heuristic of a chance where a really good business can be available for a much cheaper price than you think it's worth, because the market kind of tends to extrapolate linearly. Just to step back again, I think it goes back to our brains. So we think about, why is there this bias? I think it goes back to millions of years of evolution. We're not designed to think exponentially as much as we try to. Back on the African savanna plains, if we saw a lion coming at us, it wasn't going to exponentially go this way or that, it was going to run in a line. And I think that our brains don't think that well about these things. So it means that when we see a curve of recent past, we tend to just extrapolate that out. And companies that have these inflection points, the curve accelerates, and that's what we're trying to find.